Three stocks to buy near 52-week low. This is a video that I don't do very often, but I mainly go through a screener like Ticker, or in this case, it's finviz.com, and I just look at stocks near 52-week lows that are profitable, and I find 3 or 4 interesting ones that a lot of you have been asking about, or a lot of you are interested in. They're very popular stocks. I'm gonna talk about them. Some of them are presenting amazing buying opportunities at 52-week low in this crazy market that just can't stop going up. But some of them are just value traps, and they're trading at this level for good reasons, and we should just avoid them. And that's what I'm gonna try to find out in this video, and I really hope you enjoy it. And the first one, which is a very popular one, it's Dollar General. I mean, Dollar General, for many years and decades, it has been an amazing compounder for a lot of dividend investors, a lot of quality investors. It's been a good company. They grew the dividend a lot, did buybacks, did everything right, and it was considered some kind of a recession-resistant, safe, quality company. But since 2022, the stock has been crashing like never before, from $260 per share to $76 per share. It's trading as low as been trading at since 2017, especially recently around the whole thing with tariffs, because they do import a lot of stuff, and if tariffs go up, then they can't sell things for $1 and $2 anymore, and maybe some consumer will lose some customers in the process, and there's a lot of stuff that's going on with the company. But I'm gonna do my best to analyze it and let you know what I think. But in terms of Dollar General, the sentiment is very bad on it, and I have my favorite sentiment indicator, which isn't really available on TradingView, but it's available on my own X account. And this is why sometimes I post such things on X or on YouTube, sometimes before I buy them, because I want to know what kind of investor sentiment there is, like what kind of beliefs people have about something, if something is misunderstood or not. And I kind of know, and it's been a crazy pattern, is whenever a lot of people disagree with me, this is when I tend to be right. This is when I make the most amount of money. But if a lot of people agree with me on something, like it's so obvious that it's undervalued, I tend to lose money. It's crazy. I don't know what it is, but I just love doing it. And I did it on Dollar General again. I said it's a good opportunity, and I got a lot of hate comments, which means it could be a good opportunity, not financial advice. But that's what I try to do. I did it with HIMS at $19. I said it's the cheapest growth stock. Now it's sitting at 36, and that was my most hated post ever. Even some people called me a piece of shit user and unfollowed me. I mean, I could have made 90% in like 6 weeks, but I mean, that's how it is, you know. Traditional value investors, you know, they don't like that stuff. But you know, that's the story with my investment sentiment indicator. But for Dollar General, it's been a disaster in terms of a quarter. Net sales increased 4.2%, so it wasn't too bad. Same store sales increased 0.5%. Earnings per share declined 20.2%. I mean, it was terrible. But the worst part about it all isn't much about earnings per share declining and all that stuff. The worst part about it all is the company did not purchase any shares, and it cannot purchase any shares for 2024. And this is where Dollar General messed up. They purchased a lot of shares, 4, 5, 6% of the market cap at 52 weeks high or all-time high. They purchased a lot of stock before, but this is the time to be buying stock. Yet Dollar General is handcuffed, and they can't buy back any stock to maximize shareholder value. And this is another reason why the stock has been going down, because there's no floor, there's nothing supporting it, and you know, the dividend isn't the best relative to bond yields, and it's not the best growing company ever. But this is about to change. That's why I'm talking about it. And the main reason Dollar General can't buy back any stock is because they have so much debt. They have $6.2 billion in long-term debt obligation. This is other than the short-term stuff and all that. They have like $1.4 billion in short-term, but they paid some of it off. But they do have $6.2 billion in long-term debt. And if you look at the maturities, they still have $750 million due in 2024. They have around $500 million due, which isn't too much, in 2025. Then they have nothing due until 2027. And this is why I'm making this video, because I believe there's a potential for a change in sentiment or a change in perspective around Dollar General, because Dollar General might finally be able to start buying back stock. And I believe that's going to be extremely bullish for the share price. Why? Because they could be buying back stock soon, because they don't have much to do in 2025. They only have $500 million. In terms of the free cash flow of the company this year and this fiscal year of 2025, where they are right now, and they've been on track so far. Free cash flow has has been decent, and they expect free cash flow around $1.1 billion. It's going to be flat for a while. I'm not counting on any free cash flow growth, but $1.1 billion in free cash flow. In dividends, they pay $500 million. So that would leave them with around roughly $600 million in free cash flow. They could use the $600 million to pay whatever they have for 2025, and they still have some cash. They could take on some debt. They could even refinance. They're in a much better position right now to refinance or pay some of it off and use some of the cash to do buybacks and do other things. But they can maintain the dividend. They can pay off the 2025 debt, and then they might announce some kind of a share buyback program. Even if they don't start buying back stock, even if 2025 comes in and they say we're going to start buying stock in 2025, the market is forward looking and it might look forward to that stuff, and the stock could rally on such things, and we could put in some kind of a bottom. That's what normally happens. A lot of stocks bottom on massive buybacks announcement because it's showing that the company believes the stock is undervalued and it wants to create long-term shareholder value. And that's what it is, and I believe it could happen very soon. But in terms of evaluation, it's very interesting. Even though estimates came down a lot, and very recently they came down a lot, Dollar General, even with lower estimates, is trading at 12.5 times forward earnings. This is the lowest it has ever traded at in its entire history since 2010. This is data that I have. It's now trading at 12.5 times, which is the lowest ever. Now, normally when such things happen, it's mainly the market saying that earnings could decline a little bit more, and this 12 PE will end up being a 17 PE because earnings will be revised lower. But maybe it's not the case. Maybe it's bottoming out and it's going to get better from here. That's where it gets very tricky with stocks like Dollar General, and you don't have much growth going on in terms of earnings per share. There is some growth expected from 588, 637, and 7 and 10. I'm not counting on 2028, 2029. No one really knows. But there isn't much growth happening with Dollar General. But you don't need a lot of growth to justify this 12.5 times earnings. It's priced like it's not going to grow again, and the dividend is covered. So if I had to make a call on Dollar General, and it's not an easy call to make, I would say the stock is a buy. I'm just being honest. Maybe it could go lower. Maybe some stuff with the tariffs could change a lot of things that I'm not pricing it in. But I believe Dollar General is fairly priced according to the sentiment and according to a lot of the fundamentals and a lot of the growth and a lot of different things that the company have, with potential buybacks coming in soon. Now, if I had to buy Dollar General, I would buy a tiny position and then average into it. If it goes higher, I would add more. When it goes up, at least I would be riding the right trend and fundamentals are improving. Or maybe, I would be averaging down if something changes, but I wouldn't be putting my life savings in Dollar General. But in terms of making a call on the stock, and I try to make one-way calls, I don't try to play both sides, I would say Dollar General is presenting a good buying opportunity at $76 per share. This is the first one. The second one that's trading at 52-week low is Pfizer. And this one, it's been sad because the company has improved a lot of the fundamentals. I did a video on it a few weeks ago, a deeper dive, and everything has been improving with the company. But then now you have the change in administration, you have a new health secretary, and Pepsi is going down. I talked about it. It's been going up from my video. Coca-Cola has been recovering. A lot of them have been recovering. And Pfizer is still struggling, but it's starting to recover. And the new health secretary, he's not too friendly with a lot of the pharmaceutical stocks, like Pfizer, Moderna, and a lot of them that were involved with the COVID vaccines. So I'm not sure what kind of regulations could happen, what kind of things could happen. This is the main uncertainty with the stock, and that's the problem with investing in it. But it's trading at 10 times earnings. 10 times earnings is dirt cheap for a company like Pfizer, with the pipelines that they have and the oncology exposure that they have, which is going to be huge for the company. After they acquired Seagen, is trading at 10 times earnings, and the free cash flow yield right now is around 10%. So worst case scenario, you're getting a free cash flow yield, some buybacks and dividends, which total 10%. The dividend is a 6.3% yield, which I believe is covered from the free cash flow being, free cash flow yield being 10% and dividend being 6%, 6.3%. So I believe the dividend is safe. You get a dividend, you get some buybacks, potential multiple expansion. If they don't do anything crazy to Pfizer, any crazy regulations, anything that we're not expecting, I believe Pfizer could be presenting a good buying opportunity here. And that's my opinion on Pfizer. The third one, which isn't a popular one, but I have to talk about it because those stocks are being extremely hated. And a lot of them, all the alcohol stocks, they've been crashing like crazy. Not just DEO, but a lot of other stocks too. DEO, it's been a disaster, and that used to be a quality stock. Even Warren Buffett used to own it. I'm not sure if he still owns it. I don't think so, but it's down 26% over the last 5 years, and yeah, it's just been a disaster. But DEO owns many popular brands that you're familiar with, like Johnny Walker and Captain Morgan and Guinness, and there's so many different brands that a lot of you likely maybe consumed or likely are familiar with. Very popular one. And the main problem for DEO in the short term is they've been declining in volume, especially in Latin America. 21% decrease in volume. It's been terrible. United States has been decreasing. Europe has been, somewhat flat. Africa has been offsetting a lot of the declines that's been happening in Latin America. But over the long term, it does not have the best tailwinds or the best fundamentals, because a lot of the younger people, they're substituting alcohol for other kind of stuff that they enjoy, recreational stuff. And alcohol, I mean, is still, of course, very popular, but, if I have to think 10, 20 years from now, it's going to be less popular than it is today. That's what I believe. So over the very long term, it does not have the best tailwinds or the best trend against it, but the company is starting to get cheap. Even though earnings got revised lower, it's still trading at 17 times earnings. The lowest it has traded at was 14 times, and that was at the COVID bottom. It traded on the mean of 21 times, as high as 29, and now you could buy it for 17 times earnings with a 3.7% dividend, and they do grow the dividend very nicely, and the dividend is covered. But the main problem with DEO is you're not having much growth even in 2025. 2026 is like expected to be 6%, so it's going to decline from there. So you're getting little to no growth for 17 times earnings. So for me, DEO over here looks interesting, but I would say it's not the best buying opportunity. You could find better stocks at 17 times earnings, even PayPal, and it's still growing earnings per share. You could grow 8, 10%, or 12% even. So I don't like DEO. It's a good stock to keep on my watch list. If it gets to $100, $105, maybe, 15, 14 times earnings. But over here at 17 times, it's not bad, but it's not the best buying opportunity in the market. And this is all I have to say about DEO, Dollar General, and Pfizer. Not financial advice. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.